A refresher update on financial management. The financial management proper, procuring funds and deploying them are the two aspects of financial management. Nature and process of sourcing funds deals with procurement. Deploying them on short and long-term needs is concerned with utilization. Two broad goals of financial management: maximization of profit or maximization of the value of the firm. The idea of maximum profits implies maximization of revenue and widening the gap between cost and revenue. Profit is not a dirty word. It is a measure of efficiency and a main source of finance for business growth. Excessive focus on profit maximization is feared to be working against interests of the society, and as such, a proposal on the most viable alternative of profit optimization as a business objective for long term. Optimization of profit aims to raise value of the firm by way of higher share price. The best way will be achieving professional use of all resources, and as such, value maximization as a broader objective stays fair to all stakeholders. At the core of important decisions of a firm are investment decisions, financing decisions, and dividend decisions. Investment decisions evaluate long-term decisions for profitability and feasibility. They use techniques of payback, IRR, discounted cash flow, and net present value. Working capital decisions ensure profitability and liquidity through balancing of current assets and current liabilities. Financing decisions center around composition of capital structure, ratio of debt to equity, along with minimum possible cost of capital. Dividend decisions focus on the payout ratio based on flowback requirement and also shareholder expectations in the matter. Focus areas of CFO and finance manager as a head of finance. The all-important role starts with budgeting for funds, fund mobilization and deployment, managing components of working capital, monitoring pricing and profitability, planning the profit growth, and ensuring return from long-term assets, tax management, administration of funds and treasury affairs, adherence to standards of corporate governance, and leadership in technology, legal compliances, and corporate social responsibility. Time value of money. Reasons for preference for the present is more behavioral, unknowns and uncertainty about future, preference for current consumption, and clarity on investment opportunities for positive returns in the present. Deriving time value of money based on cash flow, finding future value through compounding, and ascertaining present value based on discounting. The cash flow may be single flow, multiple, or it might be annuity. Where the cash flow is annual and single, FV equals present value into 1 plus r to the power of n. It can also be presented as present value into future value interest factor, where the cash flow is multiple times. The concept of m is used in the denominator with interest factor, and suitably the formula is modified. Annuity is a series of equal payments or receipts over a specified number of periods. The time period is called payment period. Future value of annuity equals annuity into 1 plus r to the power of n minus 1 whole divided by r. Annuity into 1 plus r to the power of n minus 1 whole divided by r is also called future value interest factor of an annuity. Perpetuity is an annuity occurring as a stream of cash flows infinitely, like annual interest payments on irredeemable investments. And the present value of perpetuity is perpetuity divided by the interest rate. Compounded annual growth rate, CAGR, is a measure of annual growth over a specified period of time. CAGR equals ending value divided by book value to the power of 1 by n minus 1 into 100, where n equals number of years the amount is invested. Risk and returns. Variability of returns from expectations is risk. Two types: systematic risks and unsystematic risks. Systematic risks are those that affect the market as a whole. Uncontrollable factors, not specific to any security or industry. Beta is a measure of systematic risk. It cannot be eliminated by diversification, represented by market risk, interest rate risk, inflation risk, and the like. Unsystematic risks arise from known and controllable factors. They are related to a particular security or industry, can be eliminated by diversification of portfolio, comprise business risk like from product mix, competition, etc. Financial risks arising from leverage, shortage of working capital, and default risk arising from insolvency, bankruptcy, etc. Two components of a return are income on investments and the amount of capital gain or loss. Realized return equals a historical return, while expected return is a measure of anticipated return. Total return is calculated by dividing the sum of dividend and capital gain by the initial investment. There are four measures of average annual return. The first being arithmetic mean, followed by geometric mean with compounded rate of growth, and the third measure is expected rate of return, a weighted average of probable returns, and the fourth, expected return on a portfolio being equal to the weighted average of expected returns on the assets comprising the portfolio. A measure of risk may be a subjective estimate expressed as low, moderate, and high, or it can be measured using statistical techniques. and indicated as variance, which is average of squared difference of each data point from the mean, or standard deviation, which is the square root of the variance. Standard deviation indicates a spread of a group of numbers from the mean, and higher the value of dispersion, higher is the risk perception. Standard deviation as compared with the expected returns is called coefficient of variation, expressed as CV equals standard deviation divided by expected value. Larger the CV, higher the relative risk of the investment. Beta expresses the sensitivity of a security to market movements. It measures the systematic risk that affects the market as a whole. Beta depends upon the standard deviation of the security or portfolio, the standard deviation of the market, and correlation between the security and the market. In the capital assets pricing model, which is based on portfolio theory of Harry Markowitz, the key takeaways are a security's return directly related to its systematic risk, which cannot be neutralized through diversification. A relationship exists between the expected return, systematic risk, and the valuation of securities. And all securities do not have same level of systematic risk, and the required rate of return of a security depends on its contribution to total risk. The CAPM is used to define the required rate of return using beta as the measure of non-diversifiable risk. It defines expected return on the security as the sum of risk-free return plus difference between expected return on all securities or market return and risk-free return as multiplied by beta. Assumptions with reference to investors under CAPM. 1. Investment goals of investors are rational. They desire higher returns for any acceptable level of risk and lower risk for any desired level of returns. Number 2, the objective is to maximize the utility of terminal wealth. Number 3, their choice is based on the risk and return of the security. Number 4, they have homogeneous expectations of risk and return over an identical time horizon. 5 assumptions with reference to market under CAPM. Information is freely and simultaneously available to all investors. Capital market is not dominated by any individual investor. Investors can borrow and lend unlimited amount at the risk-free rate, and there are no taxes, no transaction costs, nor restriction on short-term rates, or none of the other market imperfections. Total asset quantity is fixed and all assets are marketable and divisible.